April 2026. The speculative retail market is shattering. Capital is fleeing the altcoin sector at unprecedented rates, leaving portfolios in deep depression. The fear and greed index has plunged into extreme fear. Between persistent regulatory crackdowns and the $200 million exploit of the drift protocol, retail risk appetite has effectively frozen. For most, the traditional 4-year cycle appears broken. The post-halving mania never arrived, and the retail crowds that once fueled network effects are capitulating. This data tells a dual story. On the left, retail volume is plummeting. But look at the right. Institutional assets under management and daily protocol revenues are climbing into the billions. Because protocols are now generating verifiable dollar-denominated cash flow, the market is beginning to evaluate them like traditional equities. Valuation is no longer a guess about future hype. It's a calculation of treasury strength and revenue. This environment has created a generational window for venture capital. There are 3 specific rules these firms are using to identify and acquire Tier 1 infrastructure at a fraction of its intrinsic value. To navigate this drawdown, you have to look past the psychological noise of a red market and focus on the mathematical reality of fundamentally mispriced utility. The first rule of bear market acquisition is to prioritize real cash flows. You are looking for protocols that function as businesses, not just experiments and token emissions. This requires a specific trade-off. You have to ignore the high hype narratives and accept the reality of protocol-level revenue. That revenue is what creates a sustainable price floor when sentiment fails. This table tracks the top cash flow multipliers currently in the market. Meteora is leading with an annualized revenue run rate of $1.25 billion, while Pendle is consistently generating over $44 million in fees. Maple Finance is also defying the downturn. By providing under-collateralized loans to premium corporate borrowers, they've scaled to $30 million in annual recurring revenue. The value accrual column is where the accumulation happens. Pendle's governance model algorithmically redirects up to 80% of protocol revenue back into open market Pendle buybacks. Maple Finance uses a similar mechanic, directing roughly a quarter of all revenue to buy back their own tokens. This creates a synthetic market scarcity that compounds over time. These programmatic buybacks exert constant deflationary pressure on the circulating supply. It effectively insulates the asset from retail panic by ensuring that every dollar of revenue directly benefits the token holder. The second rule is to exploit administrative mispricing. This happens when the market punishes an asset for its structure or its history, rather than its technology. When an asset's price drops, use this decision tree. If the fundamentals are failing, you avoid it. But if the price is being suppressed by temporary administrative or estate events, that is your signal to accumulate. Layer 0 is a prime example of this dynamic. It currently routes 75% of all cross-chain bridge volume globally, yet its price action remains heavily suppressed. That suppression isn't due to poor performance. It's caused by the bankrupt FTX estate, which owns roughly 10% of the supply and is systematically liquidating it on the market. You see the same thing with Mantra. Its $22 million valuation is an artifact of a complex 1-to-4 token redenomination that caused widespread retail confusion, creating an artificial pricing floor. Monad is facing a similar hurdle. Early buyers are capitulating ahead of a major cliff unlock in late 2026, driving the price well below its initial public sale point. Acquiring these Tier 1 networks during administrative confusion provides a massive asymmetric advantage. You are buying the technology at a discount while the market is focused on the supply overhang. The final rule is to front-run the institutional plumbing. Global asset managers need compliant, high-performance infrastructure to move their capital on-chain. This quadrant chart highlights the assets that are now operational requirements. Akash, Pyth, and Centrifuge sit firmly in the top right, providing the decentralized compute and data feeds that institutions actually use. Centrifuge has already built the rails to onboard complex traditional equities, evidenced by their launch of a tokenized S&P 500 index fund on a public blockchain. Pyth Network is doing the same for market data. They are currently disrupting the $50 billion traditional financial data market by providing high-fidelity, first-party feeds directly to smart contracts. For these tokenized assets to be useful, they need secondary liquidity. That is why IX is building permissioned automated market makers designed specifically for legally compliant trading. These protocols are becoming the trillion-dollar pillars of global finance. Integration mandates from major asset managers are already directing capital into these specific settlement rails. By investing in compliant base ledgers and data oracles now, you are positioning your portfolio as the mandatory toll booth for the coming institutional supercycle. To apply these rules, you have to map these assets to your specific investment profile. This matrix breaks down how to allocate based on your timeline and risk tolerance. For the yield compounder, the strategy is to stay risk-averse. This means anchoring your portfolio to real enterprise cash flow through assets like Maple Finance or Meteora, rather than betting on retail sentiment. The contrarian accumulator targets the high upside discounts found in administrative mispricings. This profile requires the patience to hold through forced liquidations in assets like Layer 0 and Monad. If you are the TradFi believer, your focus is on the macro transition. You are accumulating Centrifuge, Wormhole, and Mantra, banking on a slower, regulatory-driven growth cycle. But understand the risks. None of these are blind buys. You must actively monitor unlock schedules, tokenomic shifts, and legislative updates like the Clarity Act. Survival in the 2026 bear market depends on accumulating cash-flowing foundational businesses, while the rest of the market remains paralyzed by fear.